Okay, let's dive right into this explainer. What we're looking at today is honestly a cinematic financial thriller unfolding right before our eyes. The Reserve Bank of India is engineering a massive, completely legal vacuum to pull global dollars directly into the Indian economy. If you've been watching the markets lately, you know there's this subtle but fierce battle for capital playing out all over the world. And you should absolutely care about this, because these currency battles, they directly affect your everyday life, from the price of imported electronics in your pocket right down to the fuel going into your car. So today, we're unpacking exactly how the RBI is building an absolute financial fortress to defend against these exact global shocks.
We have to start with this crucial reality. RBI blinked before it got worse. The central bank saw the storm clouds gathering in global markets and executed a highly calculated, multi-pronged strategy to defend the rupee. But what's really key here is that they didn't just sit back and wait for global volatility to crash onto their shores. They acted proactively. You know, central banks usually react to crises, but in this case, the RBI is essentially acting as an aggressive market predator. They've launched what market insiders are calling a massive dollar hunt, and their goal is to grab capital before anyone else even realizes it's gone.
Just look at the dual pressure building up on the slide. On the left, inflation risks are up by 50 basis points. In everyday terms, that's a 0.5% jump, which is a massive macroeconomic red flag, signaling that things are getting more expensive, much faster than anyone anticipated. Then, on the right, the economic growth target is being lowered by 30 basis points. This nasty combo of rising prices and slowing growth forced the RBI into urgent action to stabilize the country's balance of payments. Simply put, they needed a massive influx of foreign currency, and they needed it yesterday.
All right, Section 1, squeezing the export window. Let's look at the first maneuver of this master plan, which focuses entirely on forcing domestic capital back home at a highly accelerated pace. Before looking outward for new money, the central bank decided to ruthlessly tighten the rules for money that was already owed to the country.
So, the RBI drastically cut the time limit for exporters to bring their proceeds back to India. Let's put this into context. Imagine an Indian IT firm gets paid in dollars by a client in the US. Historically, they had a very comfortable 15-month runway to bring those overseas earnings home, meaning they could just leave those dollars parked in a foreign bank account for well over a year. Now, the RBI is basically tapping its watch, slashing that generous runway down to a strict 9-month window.
The whole point here is that by shortening this window, they're initiating a massive squeeze. It physically forces dollars to flow back into India's foreign exchange reserves much, much faster. It's a brilliant, immediate liquidity injection that shores up the balance of payments. And the best part? They managed to do this without needing to attract a single new foreign investor. It's incredibly efficient. But, as we're about to see, they definitely didn't stop there.
Which brings us to Section 2, doubling the equity caps. Next, we're looking at the headline-grabbing move that the broader public immediately noticed, rolling out the red carpet for overseas Indian wealth. This part of the strategy is aimed directly at tapping into global stock market participants.
The RBI literally ripped up the old rulebook here. They doubled the default individual equity caps for non-resident Indians and overseas citizens of India. An individual who could previously only hold 5% of a listed company's equity can now hold 10%, and collectively the aggregate cap jumped from 10% all the way up to 24%. And crucially, they did this without requiring complex registrations with SEBI, India's market regulator. They basically took a machete to the red tape and threw the floodgates wide open.
To truly understand what they're tapping into, just look at the sheer scale of this number, $135.46 billion. With last year's remittances hitting that absolute record high, there is quite literally a mountain of wealth sitting with Indians living abroad. This policy is designed to build a frictionless pipeline from those overseas savings accounts straight into Indian capital markets. What's more, this move levels the playing field by extending these exact same facilities to all individual persons resident outside India. By letting eligible overseas individuals buy shares directly on Indian stock exchanges, the RBI is creating a vital buffer. They're actively deterring what we call hot money. You know, those speculative foreign funds that tend to vanish at the very first sign of trouble, while simultaneously rolling out the red carpet for sticky, loyal, and stable long-term capital from the global diaspora.
All right, Section 3, the secret weapon, FCNRB. This is where the story gets super suspenseful, because right beneath those highly visible stock market moves lies a submerged, complex strategy that the broader market completely missed. While everyone was distracted by those shiny new equity limits, the real heavy lifting was happening over in the fixed income space.
The RBI is dusting off a proven historical playbook here. We saw variations of this way back in 1985. But more importantly, if you remember the global taper tantrum of 2013 that sent emerging markets into an absolute tailspin, you'll know this strategy was the exact shield India used to survive the panic. Now, looking ahead to 2026, they are effectively launching a backdoor scheme to raise billions in fixed deposits through this reintroduced FCNRB route.
In a total game-changing move, the RBI itself is taking on the dollar-rupee exchange risk. They are essentially acting as a free currency insurance policy. Let me explain why this is so huge. Typically, if an overseas investor brings money into India, they worry that by the time they pull it out, the rupee might have weakened, entirely eating up their profits. But here, the RBI guarantees that if you bring in dollars at an exchange rate of 95 rupees, you will get your returns calculated on that exact same rate in 3 to 5 years. If the rupee takes a dive, the RBI eats the loss, not the investor.
Now, Section 4, the 19 by Leverage Masterclass. Let's break down the complex financial engineering behind this irresistible global arbitrage opportunity. Because I promise you, this is where the math gets absolutely fascinating.
Watch closely to see how this builds step by step. Step 1. An investor puts down just a tiny fraction of the capital, say 5% or even 2.5%. Step 2. An offshore bank in places like Singapore or Hong Kong funds the remaining 95%, essentially loaning the money based purely on India's sovereign risk. Step 3. As we just discussed, the REI completely shields them from currency volatility. And the result? Step 4. A staggering 12 to 18% return in pure dollar terms.
Let that sink in. This essentially means that for every single dollar an overseas Indian commits out of pocket, they can leverage it 19 times over. Think about that. Try walking into your local bank tomorrow and asking for 19 times leverage on a completely risk-free fixed deposit. It is practically unheard of. They've transformed a standard deposit into one of the most lucrative, risk-free products in the entire financial world today.
So what we have here is a rare triple win. The investor obviously gets incredible returns. Foreign banks get to raise deposits at much lower interest rates, slash their cost of funds, and lend into this structure with a really healthy margin. And for India, well, it dramatically bolsters economic stability. We're talking billions in stable cash locked safely away for a solid 3 to 5 year maturity period, totally neutralizing any potential economic panic.
Which brings us to our final act, Section 5, Building the Forex Fortress. So what is the ultimate endgame of this brilliant, multi-layered heist to legally vacuum up global wealth? It really comes down to scale, speed, and absolute economic security.
The RBI has designed this with immense urgency. They created a highly aggressive, short 3-month window spanning July, August, and September. Major banking treasuries are expected to scramble to offer this exclusively to their top-tier clients. The FOMO, the fear of missing out, is incredibly real here. To give you some context, when a similar scheme ran back in 2013, bank quotas were completely filled up in a matter of hours. Global investors were literally fighting for exposure to lock in these returns.
Because the return profile is so uniquely attractive this time around, financial experts are projecting that this master plan could pull a staggering $25 to $30 billion into the Indian economy, almost overnight. That is a massive, immediate war chest specifically designed to defend the currency against any external shocks.
So, by blending tighter export rules to force money home faster, doubling equity caps to capture diaspora stock investments, and launching a risk-free, highly leveraged deposit scheme, the RBI is building an impenetrable fortress around its foreign exchange reserves. It is, quite literally, a masterclass in central banking defense. And that leaves us with a pretty massive question. If the RBI can engineer a $30 billion influx this swiftly, as central banks become this tactical, this strategic, and this aggressive in fighting for capital, how will the mechanics of global wealth transfer evolve next? When the rules of the game can change overnight, who will be the next to adapt? Definitely something to think about as you keep your eyes on the global markets.